Let's get the week started. Live from New York City this morning. Good morning, good morning. Equity futures positive 0.2%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open with Jonathan Ferro.
Live from New York coming up. Chair Powell and payrolls just around the corner. China's growth target disappoints big expectations, and Credit Suisse losing one of its biggest backers. We begin with the big issue, a market-defining week.
We have the payrolls report on the 10th.
Non-farm payrolls, a big important print.
Chair Powell this week.
Chairman Powell will appear in front of the Senate Banking on Tuesday and then House Financial Services on Wednesday.
I think they'll stick to the script.
We expect him to deliver, the messages that he has been.
We still have a high inflation environment.
He will underscore the fact that inflation continues to be their main objective.
Whether you get enough of the information or before the next Fed meeting.
What actually happens in terms of the questioning of Powell is another thing.
We just have to see how the data develops.
We've got key data coming up.
We're certainly all beholden to the data at this point.
The proof is going to be in the pudding.
The Fed is data dependent. We are data dependent. The market is data dependent.
We are data dependent. Joining us now is Neuberger Berman's Eric Knudsen, Dan Suzuki of RB Advisors. Gents, to the both of you, thanks for being with us. Eric, I want to begin with you. Jason Furman in the Wall Street Journal suggesting we should go 50 at the March meeting. Do you agree?
No, I think the Fed can stay on the track they're on, 2-3 more 25 basis point hikes, and then continue to watch the situation unfold. I think that a 50 basis point hike would show a level of kind of concern, potentially panic, that would potentially frustrate markets at this point. And they don't need to add volatility in the system. There's going to be plenty of volatility associated with short-term data.
Dan, I won't bury the lead. You say people are way too focused on the Fed. Why is that, Dan?
Yeah, I think, John, the Fed was the story of last year, right? The market was mispricing inflation, mispricing the Fed. I think a lot of that heavy lifting's been done. So, all those clips that you just played about the Fed being data dependent, I think we got to recognize that the Fed at this point is not in the driver's seat. The Fed is going to respond, to the macro data, and ultimately it's going to be growth. So if you think that growth is going to slow, that's going to determine what happens to rates, the Fed, earnings, et cetera. Conversely, if you're bullish on growth, you should think that rates are going to go higher. So I think that's going to be the ultimate driver of things. And we think, at least on the data we see now, that growth is going to slow.
Well, let's talk more about that data. I've said a few times we've had 2 years worth of narratives in 2 months, January and February. When you get to March 14th, that CPI print, and you get to 8:31 Eastern time, does that narrative switch back again?
It could. I don't think it's going to change in a big way. I think that the market is intensely focused on sort of what the Fed has outlined as their focus, which is sort of services non-ex-shelter. And I think it doesn't look like you're going to see any big change there. So I think, we have to recognize that inflation has shifted from, the leading volatile components now to the lagging sticky components. And the fact that they're sticky and lagging means that they're probably going to be with us for a while, and you're not going to see a dramatic fall off anytime soon, especially with the labor market as tight as it is. So I think, that's not going to be a big game changer in my mind.
Eric, how do you think the chairman's going to approach some of this later this week, tomorrow in front of the Senate, in front of the House on Wednesday, ahead of payrolls on Friday and CPI next week?
Yeah, he's going to continue to try and walk the tightrope that he's been on. With the gradual increase in rates now, the moderate and measured pace while they wait for the data to unfold. I completely agree with our other panelists that the Fed being data dependent is now reactive, given that monetary policy works with significant lags. And the risks in terms of what's priced into the market are really around inflation being higher than what's priced, and also that growth is slower than what's priced in the market, and that's what we're focused on.
Well, let's talk about what's priced right now in the rates curve. Dan Suzuki, it's about 540 as a peak rate. Late summer, September. Would you take the under?
Jonathan, I think maybe I take the under, but I don't think it really matters really that much. I think, again, I think the Fed is more or less, fairly priced into markets here. So at this point, whether it surprises to the upside or to the downside by 20, 25 or 50 basis points, I think that's missing the point. I think that more or less, that doesn't really change the fundamental story. So then the fundamental story is going to come down to, if it's not going to be the surprise coming from the Fed and where interest rates are, I think it's going to be ultimately earnings growth. And I think that, has more risks in the markets giving it credit for.
Well, Dan, I think JP Morgan agree with you. Mislav Matejka writing this morning that their core view is that the current activity upswing is unlikely to develop into a fully fledged acceleration in the second half. They're advising their clients, they're advocating for a reduction in exposure off the back of this Q1 strength. Something you're discussing, though, Dan, I think is important here. There can be a difference between what the economy does and what you can already see in earnings. How big is that divide right now currently for you?
Oh, it's huge. It's huge. If you think about, the economy, remember that when you buy the stock market, you're not buying GDP, you're buying corporate profits. And there's a huge disconnect because if you think about the economy, it's just got a lot more supports and ballast right now. The economy, as we all know, is much more consumer and household driven. You think about the household, you think about the consumer, it's buoyed by the tightest labor market in decades. It's buoyed by the excess savings that they built up and strong balance sheets. It's buoyed by the fact that gas prices have come down a lot, and until recently mortgage rates are coming down. So all these things are very, very supportive of the household and the economy. But the debate is out the window when it comes to corporate profits, because we're already in a corporate profits recession, and that's the bigger important indicator for the markets.
Mike McKee, we get another look at the labour market, that tight labour market, a little bit later this week. Before we get there, Mike, we've got to talk about Chairman Powell on Capitol Hill.
Yeah, I think Dan Suzuki put it very, very well about where the economy is now. You take a look at a picture being worth 1,000 words. Take a look at a chart of where we are at the moment with inflation and the Fed. Inflation was coming down as the Fed raised rates, and then all of a sudden that progress has stalled out. You can see the yellow line there. That's where the market thinks the Fed is going to have to go. And historically, the Fed has always had to go above the inflation rate in order to achieve its goals. So then the question becomes, as Jay Powell heads to Capitol Hill, how far do they go? They're going to release a new forecast, a new dot plot on March 22nd. But does he give us any hints about how high that's going to be? Right now, 5.1% is the consensus terminal rate. How much above that will the Fed go? Will he put that 50 basis point move on the March table? Some members have talked about it. A lot of people leaning against it, but that may be dependent on the data later this week. What does he say about the unemployment rate? You can bet that Elizabeth Warren and perhaps some others are going to give him a hard time about the idea of raising the unemployment rate, putting people out of work in order to bring inflation down. And then what kind of fiscal policy questions does he dodge, and how he's going to be asked about the debt limit and perhaps the idea of a government shutdown, also bank capital requirements. There are a lot of things out there that are not going to be number one on the list for the markets. But here's the thing, and you mentioned this. We have Powell on Tuesday and Wednesday. Wednesday, we also get the JOLTS report. It's for January. It'll tell us how many job openings there are. There are questions about how accurate it is, but that's been what the Fed has hung its strong labor market view on. So we'll get that report just before he testifies, and then Friday after he testifies, the February jobs report. So I think right now you really can't say what the result of Powell's testimony is going to be for the markets until we get that number, and of course, as you pointed out, get the CPI the following week, because a data-dependent Fed has to have the data. Well,
Mike, let's talk about that data and go through the calendar together. You've mentioned Chairman Powell's 2 appearances this week on Capitol Hill. Payrolls on Friday, CPI next week on the 14th. Mike, do you think it's significant that the CPI print drops in the quiet period for Fed speakers, just in terms of how they might tailor their message this week?
Well, it's significant in the sense that it makes it more difficult for both the Fed in sending a message, although they can pretty much stick to their script so far of higher for longer, but we don't tell you how much. It really makes it difficult for the markets because they're going to be trying to guess what the Fed is thinking about the CPI report. And if we get a significant move one way or the other, it's definitely going to affect where people think the markets are going to have to be on March 22nd.
The option, of course, still available just to kind of leak the decision ahead of time, Mike, but we won't go there again. Mike McKee, thank you, sir. as always. I'm sure you all know what I'm talking about at home. Here's one take on things right now. Is good news just good news? This is Stuart Kaiser of Citi. He says we remain in the camp that good growth is good for stocks, particularly against the backdrop of slightly higher inflation data of late. Here's the projections from the economics team over at Citi for what they expect on payrolls. 255 this Friday, 0.4% average hourly earnings, and Chairman Powell to leave all options open but indicate a preference for 25 basis points. That mix, according to Stuart Kaiser, would be a net modest positive for equities. Eric Knudsen, is good growth good for stocks?
Well, generally, yes, of course. But if good growth means that rates are going to be higher and for longer, then ultimately that has to get priced into equities. And so far this year, we've seen rates rise. We've finally seen the market kind of line up with the Fed dots. And yet you haven't seen that have an impact on corporate, on PEs, where PEs have actually gone up over that time period. And not just that, but the best performing stocks have been the growth stocks, the longer duration assets. And we think that that needs to start to shift. That earnings quality is at a secular low in the S&P 500, and that's true in Europe as well. And that as investors begin to realize that rates are going to be higher for longer, even if the economy is reasonably good, they're going to have to start repricing equities to reflect that our earnings growth is going to be coming down. It's already come down somewhat, and that you need to discount those future earnings at a higher level. That leads us to more value stocks, high quality stocks, higher income stocks, and less into the long duration portion of the equity market.
Well, Eric, let's go through your US equity views right now. I've got large caps underweight, small and mid caps underweight. You mentioned what you did like. Which industry groups do you like at the moment?
Well, we want, as I mentioned, we want to be oriented towards the highest quality names from an earnings quality standpoint. We want to be biased towards lower beta names. We want to be biased towards quality value names and higher dividend yielding names. So that keeps us out of, some of the more speculative areas of technology, the more richly valued growth areas of the market. And then finally, we do think that there will be a demand for commodities. And so we do still like energy and materials within the context of the overall quality value theme.
Well, Eric, to your point, you don't like tech. Dan Suzuki, you don't like tech at all. Has that view changed?
No, not at all, Jonathan. I think, in fact, with NASDAQ getting close to where it was a year ago in terms of valuations, I think the risk war has actually gotten worse. So I think, we've talked about this many times in the past. Bear markets always signal a change in leadership. We've had the signal. I don't think that they're going to be the leadership, and it's still the most expensive part of the market, yet has some of the worst earnings growth out there. So I think that combination is never an attractive combination. I think there's much more attractive areas, both for the near term and the long term, if you move outside of tech.
And outside of the United States maybe as well. We're going to talk about that in a moment. Dan Suzuki, Eric Knudsen sticking with us. Equity futures right now up 0.2% with some movers going into the opening bell. Here's Abby.
Hey, John. Well, we are looking at the possibility of 3 up days in a row. The first time that we'll have seen that in more than a month. And a big piece of it, Apple. Apple is popping, of course, as Goldman Sachs is positive on the shares. A new analyst is in town for Goldman Sachs. And the first time that they're putting a new buy rating on this stock in 6 years. This analyst is saying that the company's large user base for the iPhone will help them expand its services business. They're looking at a price target of $199, suggesting that there could be more than 30% upside. Sienna having its best day since December of last year, up nearly 12%, a very strong quarter, an 80% beat on the bottom line. They also beat sales by about 10%, putting that number above $1 billion on the quarter. And they're seeing now greater than 20% growth for revenues in the current year. Investors liking it. Again, that stock up sharply. And then finally, Merck up about 0.6%. It has a new buy rating at Jefferies on valuation, plus the analyst at Jefferies saying that the street may be mismodeling its key cancer drug Keytruda. This analyst and Jefferies sees 17% upside for the shares of Merck, up a little bit this morning, John.
Abby, thanks for that. The broader market just about positive. Coming up, China setting a 5% growth target.
It's not great news, but I don't think we'd been expecting much more, frankly. And 5% that's actually delivered would be better than a sort of bogus 8.
That conversation up next.
there will be a recovery in China relative to what we've seen over the last year. And so whether that's 5% or close about to that figure, for markets, it still will be a recovery. You do need policy support. You need the consumer to be supported. But we are seeing angles of those pan out in policies.
China setting one of its lowest growth targets in decades. The announcement coming as the nation kicks off its annual National People's Congress. The outgoing Premier, Li Keqiang, saying, quote, "We are confident and capable of ensuring the implementation of policies to promote consumption this year so that it will make a greater contribution to achieving the GDP growth target of around 5%. Bloomberg's Damien Sasser joins us now for more. Damien, I've heard some people call that disappointing.
Yeah.
What's your take?
Well, I mean, 5 is the new 5.5%, down from 7% in 2013 when Wen Jiabao was last in power, right? And so obviously growth targets have come in. In China, you're looking for now 5% with 3% inflation. Nothing's really changed. I mean, that was kind of the target going into last year, although we underperformed. We came in at 3% full year. I mean, Jonathan, again, this kind of speaks to the fact that Beijing is trying to prepare the markets that this is not going to be a hard and fast reopening. It's going to be slow. It's going to be methodical, and it's going to take all year until the housing market comes back and we really see the consumption at households really kind of snap back, which is what this economy needs to hit that target.
Damien, there was a question over the weekend as to whether this more modest growth target opens the door to the reintroduction of the so-called Xi regulatory volatility. Yeah. What do you make of that?
Yeah, no, I mean, I think there is going to be a lot of uncertainty surrounding how, I mean, look, just what the topics in Party Congress, the fact that they want private enterprise to be more party-oriented. You know, there's a lot of that talk going on. Just the fact that all the new people in power are not nearly as market-friendly as those who are outgoing just speaks to, in volumes, to what she has planned over the course of 2023. But again, you know, and you have to ask Dan Suzuki this, I'm sorry, but, you know, Dan's a fan of Chinese equities because of all the markets globally, Jonathan, that are entering a profit recession. China may be that one economy that's exiting it. So, you know, there are some places in China that investors are indeed looking at here.
You've already picked out my first question, but before I get to Dan Suzuki with that, Damien, just a final one from me. 2023 was less interesting to me. That's the snapback reopening year. It's 24, 25. What does the glide path look like for GDP after this year?
Well, like I said, the direction of travel is lower, right? We were at 7% in 2013. We're at 5% now. If you listen to the IMF, we're at somewhere in the 4s. I mean, look, again, what I think the IMF even says is for every 1% in additional GDP growth in China, the rest of the world grows by an additional 30 basis points. So, you know, look, this is not good for the rest of the world. It's certainly not good for emerging markets writ large.
Damien, thank you, mate. And for the tee up as well. Appreciate it. It's an easy one. Dan Suzuki, you know where I'm going. You like China, don't you?
Yeah, that's right, Jonathan. I think, you know, long time, Damien, long time no speak. Yeah, absolutely. So if you think about the lens with which we view things, it always comes down to corporate profits, liquidity, and sentiment. And if you just look through that lens, you know, it's actually a pretty good outlook. Everybody knows all the problems that China's been dealing with over the past few years. They've been in a profits recession. They've had a self-inflicted regulatory issue. They've had a self-inflicted property crisis, and they have a self-inflicted zero COVID policy. All those things are well known to the markets and well discounted. Going forward, they're easing up on those things, and it looks like we're exiting a profits recession, as Damien said, just as the rest of the world is entering one. I think that's a great combination, especially if you pair it with, you know, liquidity, where they're lowering rates. They're telling their banks to lend, and nobody wants to invest in China.
Eric, non-US developed stocks, you're underweight. EM stocks, you're underweight. Are you taking the other side of this?
Well, we've actually been adding to EM stocks and gaining exposure to China through this year so far, reducing that underweight towards a neutral position. We remain underweight non-US developed, particularly Europe. We actually like Japan. I'll take the other side of Dan's position. We don't want to be overweight China right now. We want to get back towards more of a neutral position. China is a policy-driven market. It is also an incredibly inefficient market. So we want to have exposure in client portfolios, particularly to be able to take advantage of security selection in the market, but we're still cautious. So moving back towards that neutral weight and not ready to go overweight yet. We see more attractive opportunities from a growth standpoint in India, although valuations are full, and frankly in Japan, which will benefit from China's opening and has other positive dynamics, you know, strong stimulus, still a weak yen, and improving corporate governance, creating opportunities in Japan.
Dan, how would you convince Eric to do more?
Well, I think the concern that a lot of people have here is the geopolitical, right? And I think that the geopolitical tends to be overemphasized in the headlines and overpriced into valuations. That's why China trades at essentially a single-digit multiple and a half U.S. multiple here. I think if you just focus on corporate profits, which is going to be the most important driver, you're going to see improving corporate profit trends for at least the next 4 quarters. And I think that, when you think about the new growth forecast that came out, they shouldn't be surprising to anyone. If you look at a chart, and I think Bloomberg published one, earlier this morning, of all the annual targets over the last, 10 or 20 years, this dot fits right in line with that historical trend of, slowing and moderating growth, but not falling off a cliff and not spiking up higher either. And I think that's just to be expected. But again, you got to separate out GDP from corporate profits. I think the outlook there is much more rosy.
Dan, when you say Chinese equities, can you be more specific about what you mean? Because I think for a lot of people, when they hear Chinese equities, they're thinking of these big tech names that have ADRs here in the United States. What do you mean by Chinese equities?
Well, I think, Jonathan, those areas will participate as well. I mean, if you think about, the difference between U.S. tech versus Chinese tech is, you have a profits recession and tightened liquidity here. Well, if you turn those on its head, China is actually seeing accelerating corporate profits and improving liquidity. That's actually a pretty good environment for tech stocks as well as the broader economy. And if you look at the performance, Chinese tech stocks have gotten absolutely demolished over the last few years, much, much worse than what we've seen in the U.S. So I think, all these things represent a better risk reward for even that part of the market. But I think it's going to be much more broad than that, Jonathan. I think if we're right in this reacceleration, this broadening out of growth in China, then all areas of the economy are going to participate. So I wouldn't want to leave any of those major components out.
Highly dependent on whether you can tolerate the prospect of regulatory risk materialising, I guess. Dan Suzuki, thank you, sir, as always, alongside Eric Knudsen. Fantastic pairing going into the opening bell. Up next on this programme, the morning calls, and later, it's Europe over the United States. That's the view from Goldman Sachs' Sharon Bell. Looking forward to that conversation with European banks this year. Absolutely ripping. Equity futures right now up 0.2%. Your opening bell 7 minutes away. You are going to be told about 1,000 times over the next couple of days that you have a big week ahead, because you have a big week ahead. Chairman Powell coming up tomorrow. He'll speak again on Wednesday on Capitol Hill in his semi-annual testimony, going into payrolls on Friday, then on to CPI next week. Futures going into the opening bell to begin trading this week. Positive 0.2% on the Nasdaq, up 0.4%. Switch up the board and get to the bond market. Yields look like this, retreating from last week's high levels, cycle high. On a 2-year yield, on a 10-year yield, the highest since November, we were north of 4%. We're sub 4% now, 392.44, down about 3 basis points. On a 2-year at the front end, we retreat as well by 2 basis points to 483.38, about 11 basis points below the highs of last week. In the FX market, euro dollar 106.59. Up by 0.2%. Mr. Philip Lane over at the ECB talking up more rate hikes. Maybe we talk about another 50 after this month's 50 from the ECB. And just finally, crude, just below 79.80-ish, 79.15 at the moment. We're negative 0.7% on WTI crude. About 45 seconds into the session, we are positive, just about 0.2% on the S&P. On the Nasdaq, up by 0.5%. One stock to watch at the open is Apple. Goldman initiating coverage on the stock with a buy rating, $199 price target, expecting the company's large user base to fuel growth in its services business. Abby has more. Hey, Abby.
Hey, John. Well, yeah, this is a big call because, of course, Goldman being one of the premier investment banks in the world, now making a big call on one of the premier companies in the world, the largest company in the world, in fact. But you can see over the last year, this stock has basically been stuck in a range. On the year, it's up about 18%, but over the last year, down just a little bit. So we have this new analyst in town at Goldman who is taking a more constructive view. This is their first buy rating on this stock really in many years after having been on the sidelines actually for many years. The last buy rating 6 years ago. Now they are positive on the mix shift. You were just talking about that user base. What it means is they might be able to diversify away from the iPhone. We've been hearing a lot about this over the last several years, more into services, which is about 20% of the business, to bring that part of the pie up. So you'd have that old legacy business, but then you could layer on the new growth. Now the firm's $199 price target suggests about 30% upside from current levels. Since the last buy rating, this is really incredible. Apple is up 300%. The S&P 500 is up 60%. But the thing that they both have in common, clearly, are big, big gains. The S&P 500 being up 60% seems small relative to that 300% gain, but that's nothing to sneeze at all. So as much as a call as this is, John, on Apple, you could also make the case that perhaps it's also a call on the market for 2023.
Interesting point, Abby. Thank you. Apple's up by about 2%. As Abby pointed out, that's the first buy recommendation on Apple from Goldman in nearly 6 years. Just to bring you a little bit more of that note, just an extra flavour of it. Apple's success in premier hardware design and resulting brand loyalty has led to a growing installed base of users, which should more than offset cyclical headwinds to product revenue. Big call from Goldman. Stocks up by about 2% this morning. Another one to look at, Tesla, cutting prices on its two most expensive US vehicles for a second time in just a few months. Elon Musk saying the following at Tesla's Investor Day: "We found that even small changes in the price have a big effect on demand." Katie Greifeld has more. Hey, Katie.
Hey, John. Well, you actually have Tesla shares down slightly on that news. They've been bouncing back and forth. We'll continue to keep an eye. But this latest round of cost cuts comes just 7 weeks after they cut costs on these models back in January. And in addition to the quote you just read, Elon Musk also said last week that demand will, quote, go crazy as the company makes its cars more affordable. So let's get into some of the numbers here. The models in question are the Model S and the Model X. That includes the high-performance versions of those cars as well. You can see the Model S now starts at $90,000. That price tag was 6 figures coming into 2023. The basic Model X now starts at $100,000. And again, the fact that we're seeing price cuts again so soon after the latest round suggests that these models maybe got less of a sales boost from that other round of cost cuts than expected. And we know that Tesla needs to boost demand, even though Elon Musk again said last week that the desire to own Teslas was, quote, indistinguishable from infinite. Production has outpaced sales for 3 quarters. And in the fourth quarter, you can see there that Tesla made 34,000 more cars than it actually sold. And that ratio has been getting worse, John.
Katie, thanks for that. The stock's just a little bit lower. Is it a case of our sales prices, our cuts, your problem? Maybe. Dan Ives of Wedbush says this: Tesla cutting Model S and X prices, another smart strategic move by Musk and co. He says Tesla is in a position of strength on price cuts. We know Dan's bullish, so that's the bullish take on things for you right now. Here's another take. It's Morgan Stanley. They've removed Tesla as their top pick in US autos. They've replaced it with Ferrari. The analyst writing, quote, building on their learnings from hybrid and applying their racing DNA, we believe Ferrari can offer an EV that will be just as high in demand. I can't get my head around Ferraris and EVs, but that's a story for another day. Another blow for Credit Suisse. Let's talk about that bank, Beleaguered. The effort to win back clients is a struggle, and one of the bank's biggest backers, David Ferro, has sold his entire stake in the lender. This is what Ferro told the Financial Times over the weekend. The plan to restructure the bank is cumbersome and far more costly in terms of cash burn than we expected. We were also not satisfied with what we were getting in terms of proceeds from the sale of securitized products. Shanali's been following the story. Shanali, find me some good news for this company right now.
Listen, this is the sale that you're thinking of here, the securitized product group. These are what happens when you sell things in a down market, John. You're just not going to get what you get when you try to sell things when things are good. Now, remember, David Ferro in particular has held the bull by the horns for a very, very long time. Credit Suisse never regained the former glory of the pre-2008 era. And remember, even now, he's selling at historic lows. He told the Financial Times he started selling around October when the Saudi National Bank took a stake. If you take a look now, what's interesting about the top shareholders of Credit Suisse, you are looking at a group that is largely contained in the Middle East. That is the Saudi National Bank, that is investment vehicles tied to Qatar, QIA, and now the Olion Group, with the exit of David Ferro, also becomes a top 5 shareholder. So as the bank shifts towards international wealth, they now have a hefty group of Middle Eastern backers on their side. Now, I also want to take a look at a popular trade here, because more than the shares, you're looking more at the credit default swaps of Credit Suisse trading more actively because you are looking at CDS that has widened pretty meaningfully this year. It's not at the wides that you saw early this year or even last year. It's not a meaningful risk of default you're seeing here in the bank's shares in CDS. But what you're seeing is a concern among investors that is reflected by David Harrow's view that it's not a risk of crashing, it is the risk of limping along. The question now with potential outflows this year is how long do they limp along for, and do they meet the new goals that they've set forth?
Just as the rest of the industry recovers in a major way across Europe. Shonali, thank you for that. And I'm talking specifically, almost exclusively, about the stock price over in Europe right now. Look at Credit Suisse year to date, now negative on the year. Look at UBS, up close to 20%. Look at the overall universe of Eurozone banks outside of Switzerland, up 24% on the Euro Stoxx 50 for the European bank names right now, year to date. And over the last year, even bigger moves than that. David Harrow spoke to this in the FT. He said rising interest rates means lots of European financials are headed in the other direction. Why go for something that is burning capital when the rest of the sector is now generating it? To discuss, Sharon Ballard, Goldman Sachs, joins us right now. Sharon, wonderful to catch up with you. I remember you said a number of months ago on this programme you liked European banks. It's working out. What's great about them?
Yeah, it's been the perfect environment for European banks. You've had growth pick up in Europe. We've had higher interest rate expectations, and banks enjoy an environment really of higher interest rate expectations, increases their net interest margins. So it really has been a kind of a perfect recipe for the bank sector. And they started off with quite low valuations. The earnings season was extremely good, both the third quarter one, but the fourth quarter one was really above expectations. So it's absolutely been perfect for the European banks.
Sharon, we've had this story of a valuation gap between Europe and the United States beyond the banks at the index level for quite a while. It was a valuation trap for quite a while. I take from your stance, Sharon, you think that's really changing, that valuation gap is not warranted or deserved. And I was going through your work and you said you were looking across utilities, staples, energy and banks. What do you see there across those four areas?
Yeah, there are quite a few sectors in Europe. So first of all, I would say, yes, there is a big gap between US and European valuation. Do I think it should close entirely and Europe should trade on the same P multiple as the US? Absolutely not. The US has higher growth companies. It has a much bigger tech sector that tends to attract a higher valuation. So I wouldn't expect it to disappear. But yes, every single sector in Europe trades on a discount to its peer sector in the US. And that discount is generally quite big versus the past. Consumer staples, which perhaps aren't in fashion at the moment, they're a defensive area and growth is improving a little bit, but they trade on a big discount in Europe relative to similar names in the US. The energy sector is one of the ones with the biggest gap, though. You mentioned that sector. It trades on a much lower multiple in Europe than it does for its counterparts in the US. And really, they're in a very similar business. So we do think the gap should close a little bit for quite a few different sectors.
Sharon, just on energy specifically, can you explain that valuation gap because of a windfall tax, a regulatory push in Europe that maybe doesn't exist here in the United States? Does that explain it?
Yeah, so there's a little bit of that. I mean, bear in mind that the companies in Europe, the large European energy majors, make their profits globally, and they will pay their windfall taxes where they make the profits. So some of these windfall taxes will be put on US companies that also make money in Europe and elsewhere. So yes, I think a little bit for the windfall tax risk and imposition. I think also quite a bit for the fact that ESG funds tend to have very low weights if they invest at all in the big energy majors in Europe. Whereas obviously those funds have grown everywhere, but particularly in Europe. So I think those are the factors that keep European energy stocks at a big discount. But in terms of who wants to buy energy stocks at the moment in Europe, actually you don't really need a buyer outside of the sector itself. The energy sector is buying back shares. So we've seen huge buybacks in the last year. I expect them to continue this year. They're the biggest buyer at the moment of energy stocks.
Sharon, for a long time, we talk about the index level, Europe versus the United States, and the easy explanation for the discount was just the sector mix that existed in the United States, much heavier in terms of tech, which explained that valuation premium. Sharon, do you think then, looking at the sectors, adjusting for that, that it goes beyond that?
They absolutely do. So every sector in Europe is on a discount to its US sector. So even if you do put them on the same weights, use perhaps global sector weights to weight up the valuation of US sectors, do the same for Europe, you still get a big gap. You can perhaps close about a third of the gap difference between the US and Europe, just putting them on the same sector weights, but still 2/3 remains. Some of that's Europe's typical discount to the US, And I understand why Europe should be on a bit of a discount, lower growth economically in Europe, perhaps a little bit more sovereign risk in Europe. But the discount at the moment is particularly large, and it's true across lots of different sectors. And tech is a good example. There's a discount for Europe, a very small one between European tech and US tech. But actually in the next couple of years, based on the consensus, European tech has a better growth forecast than US. So should it really trade on that type of discount still?
Interesting. That's what I wanted to talk about, just to finish on it. The next year or so. So Sharon, year to date, great call. It's materialised. I can see the moves. France earlier this morning, another record intraday. CAC 40 year to date up 14%. Germany up 12%. Spain up 15%. Italy up almost 18% year to date. There might be some people who weren't in this trade, Sharon, that saw that and just thought, OK, I've missed it. I don't want to go there. What do you say back to them?
Yeah, I think Europe can outperform the US, but I wouldn't expect super strong returns from here for either side of the Atlantic. I think the problem is we've already priced in a lot of sort of the potential improvement in growth. We've already priced in a lot of that. And of course, interest rates are rising. Those sort of rising interest rates expectations mean there's another asset class you could potentially invest in and get a risk-free or close to risk-free return in bonds, sovereign debt, in cash even. So I think the attractiveness of equities relative to those has come down a bit given the performance. But having said all of that, I do think Europe looks cheap versus the US. You still get a good income and dividend from Europe. You're still kicking off quite a lot of cash. The companies are buying back shares. And European growth has improved quite a bit. So all of those things mean Europe probably outweighs the US in terms of, sort of investor returns for this year, in my view.
Just massive moves already year to date. Sharon, thank you as always. Sharon Bao there of Goldman Sachs on the European story and the outperformance we're seeing in Europe year to date so far. Higher rates helping out the big banks. At some point, even higher rates become a problem. I have no idea how far or how close we are to that moment. The S&P 500 positive 0.4%, about 13 minutes into the session. The Nasdaq up by 0.5%. Coming up next, US lawmakers taking aim at tech in China.
In terms of foreign technology coming into America, we've got to have a systemic approach to make sure that we can ban or prohibit it when necessary.
That conversation still ahead.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, an exclusive interview with J.P. Morgan Chairman and CEO Jamie Dimon. That's at 11:40 a.m. in New York, 4:40 in London. This is Bloomberg.
In terms of foreign technology coming into America, we've got to have a systemic approach to make sure that we can ban or prohibit it when necessary. Got 100 million Americans on TikTok 90 minutes a day. They are taking data from Americans, not keeping it safe. But what worries me more with TikTok is that this can be a propaganda tool.
US lawmakers stepping up the push to ban TikTok. President Biden closing in on an executive order to restrict US investments in China tech. The administration writing in a report seen by Bloomberg that the objective is, quote, preventing US capital and expertise from being exploited in ways that threaten US national security while not placing an undue burden on US investors and businesses. Team coverage starts right now with Bloomberg's Anne-Marie and Kelly Lyons down in DC. AMH, talk to us about what's on the table here.
Well, Jonathan, you just see Washington continue to address the Chinese Communist Party and adding more tools to their toolbox. One comes from the White House and the other is from the other side of Pennsylvania, coming from lawmakers. So first you have the White House. This is really a long time coming. Reports for months about this executive order. But what would it do is restrict investment into certain parts of the Chinese economy. These parts, the administration think that this advanced technology that this investment would go to could enhance either the Chinese Communist Party military or as well as their intelligence capabilities. And we may get more details about it today because Biden will be unveiling his budget on this week. Then the second part of this is just another bill that either it names TikTok or not, it will go after TikTok. You have Senator Warner on Fox News on Sunday saying that this has broad bipartisan support. He's working with South Dakota Senator John Thune, and this would basically ban this kind of technology in the United States. But this has to be the 6th or 7th bill that is going after TikTok. So at some point, one of these, you imagine, is going to get across the finish line.
Well, I just wonder how narrow this might be. Anne-Marie, just reading that language, technologies that could enhance China's military and intelligence capabilities. Based on what they've been saying, is TikTok part of that?
Well, that's a great question. If you think about intelligence capabilities, TikTok could potentially be part of that because many view it as the Chinese Communist Party is able to, because TikTok is owned by ByteDance, a Chinese company, is able to gather intel and data on these users in America. But we should note, Jonathan, and at the end of the month, the TikTok CEO will be in Congress. He will have a hearing and he will be testifying. They are spending billions of dollars really on this project called Project Texas. They're working with Oracle. What they want to do is make sure they can show CFIUS, U.S. lawmakers that there's a way that they could still remain active in the U.S. and keep the U.S. data safe in the United States. And they're working with the European Union as well for something similar in Europe.
And Katie, two words here that stand out: capital, expertise. That's not just money, that's talent too.
Yeah, exactly, John. But the money, of course, is ultimately a good deal of what matters to the markets. And when you talk about technologies that could limit the advanced military and intelligence capabilities of China, this could reach into a lot of different areas of Chinese technology, including chips and chip makers, makers of manufacturing equipment, anything related to AI and ChatGPT and quantum computing as well. So as a result, you are seeing this show up in the ADRs of some of those companies, the likes of Alibaba and Baidu, BDD, all down this morning, even about 2% in the case of Baidu and PDD. And when you look at the Golden Dragon China Index, which of course tracks a basket of those stocks, it is down about 1.3%. All of these, of course, listed here in the U.S. John, we had seen years ago a big boom in IPOs of Chinese technology companies here stateside. Alibaba, of course, back in 2014. That has started to trickle off. In 2022, there was only about $500 million worth of IPOs here. It has gotten a lot more difficult due to the headwinds around geopolitics and, of course, a lot of questions around auditing as well. This now would add another layer on that investment difficulty and adds another layer, perhaps, of difficulty for these stocks because we know, John, over the last several years, these have been underperformers. Yes, the Golden Dragon China Index is up about 70% from its low back in October, but still over the last 2 years, it's down roughly 57%. And Chinese stocks as a basket dramatically underperforming the rest of the world, down about 40% over that time compared to the All-Country World Index, down just about 2.3%, John.
Wow. AMH, I just want to give you the final word. Away from the equity market just for a moment, just on the politics. We heard from the former President Donald Trump over the weekend campaigning. We heard from the governor of Florida, I won't say campaigning, but certainly on the media tour still, ahead of potentially announcing he's going to make a run. Is China going to be a big feature of this upcoming election in 18 months' time?
Well, it absolutely is. What did you see this morning with the Daily Mail? An opinion piece from the former President Trump talking about COVID and how he wanted to go after the World Health Organization because he thought they were deferential to China in the beginning of this, because also we've had recent reporting coming from the Department of Energy that they say this was a lab leak potentially. So, Jonathan, China, whether or not it's COVID, whether or not it's investment, whether or not it's the data, many lawmakers say they are harvesting in this quote-unquote Trojan horse, the United States through TikTok. China will become this #1 enemy for lawmakers, not just in the GOP, though. This is going to be as well for President Biden, who's expected to make his campaign as well. He's going to show all that he's done while he was in power to try to make sure that they are competing with China and keeping American data and money safe.
AMH outside the White House, thank you. Kelly Lyons down in D.C., thanks to you too. Big story over the next 18 months, that's for sure, potentially anyway. Into the equity market, 23 minutes in, we are positive by 1/3 of 1%. Let's get you some sector price action. Here's Abby.
Yeah, John, and that is the first 3-day upswing for the S&P 500 that we've seen in more than a month, the most that we've seen the S&P 500. So not surprisingly, we're looking at bullish sector action. Tech really helped out by Apple. We also have some of the other mega caps following along, communication services. And just to tie the bow on the bullish year so far, take a look at technology, the best sector, the 3 down sectors this year, John, they're all defensive.
Abby, thanks for that. Up next, your trading diary. Almost 26 minutes into the session this morning. Good morning to you. Equities broadly positive by 0.4% on the S&P, on the Nasdaq up 0.6%. Let's get you to the trading diary. What you need to be looking for. Top of the hour, US factory orders and durable goods. On Tuesday, Fed Chair Jay Powell kicks off 2 days of testimony on Capitol Hill. ADP numbers, monthly JOLTS report coming up on Wednesday. President Biden releasing his budget proposal on Thursday, and finally the big one on Friday, the payrolls report to round out the week. A sneak peek of our survey, a moving target, but a median estimate so far 223,000 for Friday's payrolls. From New York, this was the countdown to the open. This is Bloomberg.